All right, welcome back everyone to another episode of In the Charts. We got the regulars here today, Diogo, Monica, Breckenridge, Stachel, and myself. I get the honor of kicking off today, so I'm going to share my screen.
I love that you used Breck's full name that nobody actually knows. You just
I
doxed
I
I
him.
only
doxed him.
get I only get Breckenridge when I'm in trouble. Am I in
Well, let's
trouble?
see. If you're not bringing
Ne-
a chart and you're bringing a pie or some other like form of chart, then yes, you'll be in.
Next time I'm going to dox your middle name too. Um, all right, so here we go. So my chart today is about AI, and I actually brought two charts, so I cheated today. This first one is a chart of 15 years of Reddit relationship advice, consisting of over 1 million comments. And basically, on the y-axis here, you've got percentage of the type of advice given. You've got years across the x-axis. So in red, you've got advice that says basically end the relationship. In blue, you got communicate better. Green is give space and time, set respect and boundaries in orange/yellow, seek therapy in person, compromise in this teal color, and then everything else in gray. I think the way to interpret this is like red is end the relationship. Everything else is some form of try to make it work. And what you see here is that actually Reddit advice has gradually from 2010 to 2025 increased the advice of end the relationship, where it's now basically about almost half of all the comments given, and everything else has lost share. The thing that's lost the most amount of share, you can see, is give space and time. Communicate has also kind of fallen off a cliff. And I bring this up because, as we know, a lot of people are now asking AI chatbots, their agents, whatever your setup might be for relationship advice, and they are being trained on this type of data. And so increasingly, you get pointed towards now end the relationship instead of try to make it work in some form. And this will have probably massive societal impacts because a lot more people are going to be seeking advice this way rather than this is now very sensitive topics, right? And historically, you would go and ask this to your closest friends, but even that is you're sharing a lot of personal information. So I wouldn't be surprised if more and more people gravitate toward asking their agents or the chatbot instead of real people. And so this is most likely going to be the type of advice that they get. One other chart that I'll share that's kind of along similar lines is this one. And this one is a chart of basically all the different, or not all of them, but some of the most popular AI models. So on the top left, you got ChatGPT, Gemini, DeepSeek, Grok. And this is actually of the political slant of the actual chat slash model in blue relative to the actual general population, which is in gray. And what this shows is that actually the AI models are nudging people more towards the middle, as in they're eliminating, the extreme ends more so than the actual general population believes. Obviously, each model has their bent, as you can see. But generally, all of them are pushing people towards the middle. And so this is also pretty interesting because this is counter to what's been happening over the last, call it 15 years of social media, where it's actually pushed people towards similar thinking and as a result of that, more towards the extremes. So I felt like this is pretty interesting. Like it's the first time, I think, since really the internet has taken off that we're getting more centrism versus extremism. So I'll pause there. I'm curious to get your guys' feedback on this.
Wow. First thing I noticed just by looking at this chart specifically is I think ChatGPT might be more left than DeepSeek, which is kind of an indictment on OpenAI. Like, or they're at least like kind of similar, which is kind of a funny observation. Um, I'm surprised by this chart. First and foremost on the centrism piece, I guess like the intuition is that the more extreme your position, maybe the less nuance you have. And models are actually quite good at providing context. And they can like both ingest context, but also like, give context back. And maybe that's why they're actually like good context machines for individuals that maybe are not as good at that. Um, so maybe that's the reason for why you end up being more like center versus extreme. Um, I don't know. I'll let Diogo comment on this, and then we can hear the other chart because I also had some questions on the other chart.
This is, I think, one of the most hopeful charts that is out there for society at large. A world of extreme polarization is actually being brought back to the center by reasonableness. Before I saw this chart, I actually had this experience many, many times in person. So I have a friend that shall not be named that believes in the theory that 9/11 was a hoax. He's otherwise a smart dude. He saw some documentary that he believes to be credible, and he saw maybe he was in a vulnerable moment, and he basically internalized this idea that the things that they were talking about were impossible, and basically had this like full conspiracy theory, regime in his mind about what was actually going to happen. And look, maybe 1% chance that this is actually the case, but there were so many factual inaccuracies of the facts that were kind of being presented. And so essentially what we did, it was like, look, I talked to him, what do you think about LLMs and ChatGPT? And essentially what he said is like, look, these things are amazing. I've had so many experiences in which they know more than the person itself. He had a problem with his fridge. The technical guy did not know what was happening. He asked ChatGPT solved it. He had a problem in his business. He was asking kind of like the accountant didn't know what was happening. He solved it. And he had a personal medical issue where he had gone for years, like from doctor to doctor, and literally ChatGPT diagnosed the highest probability event, and that ended up being confirmed. So he's so ChatGPT built. So I use that to say, from personal experience that these things are better than any expert that you talk about, all of these. So let's actually do this. Let's craft you and I a prompt that is on your phone, that is completely unbiased and going to ask about not the 9/11, so it doesn't bring that context, but the physics of what you're asking. Do you trust it with physics? Yes, I do. So things like, can this thing actually go down when temperature is high enough, or is temperature high enough actually to cause issues with reinforced concrete, and could a collapse like this could actually be, so you kind of like start building upon the trust that they already have in ChatGPT and ask questions that are not polarizing. You never actually mention the 9/11, the event itself. And you end up in a place where for the first time, I was in a debate where I was able to change or open a window to changing somebody's mind without making one single argument. It was not him versus me. It was me guiding him through something that he already trusts in thinking from a first principles perspective in crafting prompts. I was not telling him he was wrong. I was just, let's think about this from first principles. And this chart is just, it's that on steroids. And I think it's actually one of the most hopeful charts that we have for humanity that brings back polarization back to the center, because these things are so convincing and they're trained on so many data sets that they actually, by and large, they're going to have hallucinations, but they're reasonable and they're centrists. And I love this. So I've just been thinking deeply about what actually this means as one of the shining beacons, not just for the United States economy. AI brings us out of the hole in that spiral we're on, but also the polarization that we find ourselves in. Sorry for the long monologue. This one is a great one.
That's a really cool
That's
story.
really interesting. Yeah, that's really interesting. I had not thought about it like that. So actually, um I probably changed my mind on this after hearing your anecdote, Diogo. Like what well, two lines of thinking that I was going on, which is that I think when used in that way, which is as a research tool, where you are trying to examine the inputs rather than just getting the simple output, I think it's incredibly useful, and it can help to shape people's thinking in a really positive way. What I'm a little bit afraid of is when I combine these two charts, which is you end up converging to the median advice or the median thinking. And because like, you know, the models themselves are trained on a corpus of data, and they're probabilistic. And so if probabilistically most people are encouraging end relationship, they're going to be more biased in that way. And it's not exactly the same, but I think there's like maybe this tendency to try to converge to the median.
Can I
And
ask
that's
you
what
a
I'm afraid
question?
of.
Can I
Yeah.
ask you a question? So
Yeah.
I think the general trope is that since they're trained on the data sets, it's the median or the average or whatever. Do you actually believe that to be the case? Because the way these things get trained and fine-tuned is by extremely smart people that actually create these like thinking frameworks and step-by-step thinking where they check their own assumptions into the models. And so I would actually make the potential claim that we're not seeing the median at all. The training corpus is the average or the median, but these things as thinkers and first principles thinkers in itself are being nudged towards what I would actually assume their top 10 percentile or fifth percentile. So they're on the top 95th percentile of actually quality of advice. And so actually what you're going to get is
Yes.
you're going to get a massive improvement in the general advice because the median person is absolutely horrible at it. And the models are actually going to be really good because of the way they're being fine-tuned and actually engaged with. That would be my instinct.
Yeah, no, I think actually I'm generally in agreement with you. I think the challenge is that the more context you feed the prompt, the more context you feed the model, the better their output's going to be. And what I worry about is like the average person is just going to like ask very surface level questions, and maybe it's been trained enough to like ask deeper sets of questions to be able to actually diagnose. And if we go in that direction, I think that's phenomenal. But I've also experienced cases where I would have this conversation with the model, and then it would spit back to me some answer immediately, and then as I dig further, the model starts to change their mind depending on what context I feed it.
Right.
And so what I fear is that most people don't go through those extra levels of examination and research, and then they kind of take the blanket advice. And I think the blanket advice starts to tend towards the median. So maybe this is solvable just by creating some extra friction steps, which is like try to have the model ingest some appropriate level of context before it starts to feed you the advice. But I think that would be a really positive direction.
I agree with you, and it's happening. It's what I was about to say.
Yeah.
I think it's happening right now. So a lot of my model interactions right now, it clarifies and asks me, even in a really interesting way. I didn't know this. Perplexity does this all the time now. It actually asks you a set of options. So it's basically like a questionnaire. You ask it a question, and in fact, what comes out is a questionnaire.
Yep.
So it kind of like fine tunes the direction. That's pretty good. And the other one is specialization of like, the psychologist model. There will be someone that will be approved as a psychologist model or whatever model.
Sure.
And those will be the ones that we'll actually use for advice, hopefully. And so those will actually be better at these kind of like human things.
I generally agree with all these things. I think Diogo's anecdote is like still pretty prescient. Like I was just in South Carolina this past weekend where my family is from, and most of them do not use AI very much. And they think of it as still like kind of a replacement to Google. So they're not actually giving context. They're like searching SEO style terms and they're getting that stuff back. I do think that, like, Chris, you're 100% right. If you're not using these tools effectively, you're going to get like the not super effective version of these models. But once you find one thing, like the refrigerator example, one thing where it was actually like an aha moment, where it was better than the mechanic or the specialist who came into your house and spent 2 hours like not fixing your thing, like then you kind of like start to realize and are trained how to use these things better. And that's the hopeful and exciting piece that I think Diogo is trying to echo, that I definitely agree with. And there's like a big learning curve. The tail is fat here. A lot of people don't know how to use these models very well. So I'm hopeful. Should we go to the next one?
Chart.
Let's keep going.
Okay, let me share my
Chris
screen.
wins without seeing the other two charts.
Yeah, good chart. My chart's going to go in a pretty different direction. So I don't know why I started doing this, but I was going down a rabbit hole for credit cards. And like trying to better understand how like credit cards broadly work as a system. And so what this chart shows is the like net value that is extracted from one type of party, and then the net value that is like paid into the system by another party. So there's roughly two parties in consumer credit cards. Like on the consumer side, there are the people who pay their monthly bill on time and don't incur debt and don't take out a revolving line of credit. And then there are people who have a revolving line of credit. The people who are let's call it the transactors, they basically only receive benefits from the credit card companies. They receive cash back, they receive rewards, they receive credit card points. And this chart shows that as of 2024, something like $25 billion went to the people that paid their credit card bills on time, just in cash back and rewards. Now, unfortunately, the red line is a lot bigger and on this chart, and that shows the amount of money that the people who don't pay their credit card bills on time and have to actually have revolving line of credit pay into the system to subsidize those rewards. And that's on the order of like $160 billion a year, which was kind of a staggering figure to me. It's also important to note that this is a gross figure; it's not net. So, like a dollar amount of the $160 billion in interest and fees paid by revolvers is going to be defaulted each year. So it's not like pure margin back to the issuers. Maybe it's like 40 or 50%. I don't have the exact figure, but it's still a lot bigger than the rewards that transactors receive. Um, and I guess this is why being a credit card company and being an issuer is like such an amazing business, but it seems like a pretty predatory business. And the only thing that I could see here, and Chris and Diogo will know this because I've been talking about this at the office, is like there's got to be a way that we can use AI as a way to help optimize spending intent. Because a lot of the spend here is actually like necessity. It's people paying for groceries. It's people paying for maybe like their housing or paying for like healthcare, and it's just kind of like a depressing chart when you go that path. But then for us as people who are parts of businesses, like we use credit cards like Ramp that fully optimize our spend and use AI to make sure that we're like not spending too much money. And I can't help but look at this chart and feel like there needs to be a consumer product that helps people spend less versus, optimizing for giving rewards to the transactors. So I wanted to open up a conversation, see if this chart, evokes some emotion or like interest from you guys.
I think the problem may be too far gone for any kind of AI optimization to be able to help us. The problem here is structural. It's not really a problem of spend management or intent management. I think
You don't think so at all?
I think the market is broken. The market is just broken. There might actually be one of the places where regulation has to step in. The same way that for debit cards, regulation stepped in for the Durbin Amendment and made it profitable for people, or made it much cheaper for people to take on debit cards, and created a whole new set of businesses that people are actually building on debit card rails, even Square Cash with unlinked refunds as a way to move money fast and cheap in the United States. And the credit cards are just captured. And it's just the payers are benefiting the richest people and the corporations, and clearly like the direction that is going is the wrong direction. And so this speaks to me as a captured market at this point after so many decades of this. I'm all for free markets. Seems like this may be one of the cases in which the free markets are actually not working out very well for us.
Yeah, that's fair. And just to illustrate that point, like the reason why it seems like it's accelerated over from 2021 to 2024 is the state usury laws actually increased from the average credit card APY being 16% up to 23% over those 3 years. And then with inflation, people just can't afford their, household goods and services.
That's kind of the key question that I have, which is, it's hard to know, but what portion of the actual credit card debt? So, to be precise, right, we're talking about merchants pay into the system, right? And then the other people that pay into the system are people that actually take out loans against their credit cards, like people that actually take out,
Correct. That don't pay their
outstanding
bill
lines of
at
credit.
the end of the month.
Correct.
Yes.
Correct. So, and those people, they're paying into the system quite heavily because the interest rates are quite high. And so the question is like, why? Like, why would you take out like a consumer loan for like 20% APY? And if that's because there is no other access to capital and they need that capital, I don't know how much margin these folks are collecting off of this, but there's a question of access versus consumer protection, which is an age old problem, which is like if I'm somebody that like needs this capital and I don't have access to it anywhere else, or it's like a payday loan somewhere else that's going to charge me even higher interest rate, then maybe this is actually the lesser of those evils. So I don't know for sure because I haven't done the deep analysis to know like why people are actually taking out these loans, but I think that's a critical portion too.
Yep. So if you look at the split, it's like it's people paying for things that they need on a like day-to-day basis. It's not that people are spending too much on discretionary goods, like buying, I don't know, flat screen TVs or whatever it may be. It's like people paying for like their groceries, people paying for like healthcare bills, people paying for housing on their credit card. And the thing that I would posit is like, uh, I have a feeling there's got to be a way that you could have a business that's optimized for making that red thing go down versus go up.
Yeah. I
So like what Ramp does, right, is it takes a business who needs to have a positive P&L, and it makes sure that like the spending portion is at least optimized to the extent that they can. And there's just like not a consumer product that like looks like that. And I'd be willing to
yeah.
bet that a lot of the people who have a revolving credit line don't know how expensive it is to their like aggregate costs for the year or over a few years.
Yeah.
And I don't know. It just feels like a low hanging fruit that I would like to see someone try.
Yeah. The equation on this is like there's amount of credit, and the amount of credit is somewhat dictated by the actual velocity of capital. As in, if I get paid every 2 weeks, or if I get paid every week, but I need to spend every day, then somebody is going to have to bridge me that gap. Of
Yes.
course, like if I'm spending beyond my limits, that's a whole nother set of issues. But assume like
Which is
you're
what people are effectively doing. They're
sure,
spending
but
beyond their
that's like
beyond their means.
that's a whole nother set of issues because that's like a that
But
just
I think
stacks,
another set of
right?
issues is the issue at du jour, because I think Breck's expectation, and I think it's correct, is that if we give people ramp-like visibility onto their spending and how much it costs, and maybe project forward how much they're going to be in debt, that it would like limit some of the issues, which I would agree. But the problem is people don't have another place to go. They don't have another place to go. They don't have
Right.
another place to spend, and they need to buy groceries or pay for stuff. And so that's
Yeah.
why it's like, one person dying is a tragedy. 1 million people dying is a statistic. I think we're getting to the place where this is a structural problem of the market, and there may be no like single fix solve because people need access to capital, and this is the way that like the
I,
underwriting has gone.
Here's
I
an
think the
example
easiest
though.
thing.
So like
Go ahead, Breck.
2020, 2021, you see like a shift where actually like that the red part of the chart goes down. That was because of stimmies. Like during COVID, everyone got a stimulus package of like $2,100. I can't remember the actual figure, which I think goes to show that like the margins here are pretty thin. Like if there's 10% of a consumer spend that could be optimized using like an AI assistant that told you like, hey, like you can get cheaper groceries here, or like this healthcare provider might actually be a better. Like if there's just someone who's like acting like a CFO for an individual, I have to imagine that like we could tip the scale in a different direction.
Yeah.
And I don't
I
think
think
it's
there
as like far gone as Diogo is making it seem.
I think there are
At
two
least that might be the point.
optimizations. There's two optimizations. Number one is that, Breck, which is like more transparency and better decision making is what we're talking about. I think the
Correct.
second one though is like if you can reduce the time to settlement just generally across like purchasing, across payroll, like in the financial system, we just have so much latency basically. And to the extent that you can compress that latency and actually make the money move faster, then I think that's another way to reduce the amount of credit that needs to be issued in
Yep.
order to have the same type of transaction happen. I think that's one of the areas that stablecoins can actually help a lot. So that's where I'm actually very optimistic is that, there's a behavioral problem, which you're touching on, Breck, but I think there's also like a technological one, which is that like slow settlement speeds equals increased credit. And I think we can also reduce that without having to change anything else.
You guys heard it here first. Stablecoins fix this chart.
Can I just I love it. Brett, can I just tell you one thing? If to bring this chart down from 2019 to 2020, 2021 with the stimmies takes the $2 trillion of the CARES Act, then we're screwed. There's no $2
I know.
trillion a year of economic
I
value
hear
that
you.
any AI you create. Maybe there is. I don't know. Maybe there is. But it took $2 trillion to get that thing down.
I hear you. I hear you.
But
I
maybe
don't
there's
know,
another
and I don't.
equilibrium. Maybe that it slows the growth. So
And I
I'd
don't
like
know
to see
what
it.
percentage of that like stimulus package went to individuals versus PPP. Like I don't know. Like I didn't like do.
No, I think the 2 trillion were all individuals. I think it was $500 billion in direct checks. So the stimmy checks themselves were $500 billion.
Sure.
But then there was unemployment. There was like a bunch of other stuff, but that was all it's still like it was to the pocket of the consumer. So I think it's actually the number is like 1.9 or 1.8 or 2 trillion. It's $2 trillion of like economic value during COVID straight to the pocket to the consumer.
It's more than $25 billion in less credit card debt, which is what's illustrated on this chart.
They might as well just clean up all of the debt. Just like buy the debt.
Let's print more money.
Print more money. Why not?
Yeah, I don't know. This chart is just like a concerning. Like as a member of society, I'm like, man, this is a bad chart, and I would like to see there be efforts either at a macro or micro level make this chart like not as shitty. And yeah, I don't know how to do that. But AI is like the topic. It's the thing, the tool that you can pull off from the toolbox today, and I have a feeling like you could do something to optimize people's spending. So
it's stablecoins, man. It's not AI.
Yep. Fair enough. On to the next.
Okay, it's my turn. Okay, I'm gonna share this chart with you. Screen, and there we go. This is the chart. Okay, so Chris brought a positive chart. Breck brought a negative chart. I will bring a negative chart, but talk about the positives. Okay, so what the chart is showing, and this chart is making the rounds from the block. It shows us the monthly crypto VC deals, and so on the x-axis is time, on the y-axis number of deals. It also has some coloring around strategic seed rounds, pre-seed, token sales, etc. And what it shows is that the number of deals in crypto has actually reached the same level as 2017. And so it's down in terms of count to, tens of deals right now. So 50 deals per month. And this is making the rounds. And if you look at without context, it basically looks catastrophic, okay? 2017 levels, and then it's over. It's basically like, it's over. That's the energy that it was posted with. In the replies are, what do you actually expect? It's half doom, half cope. And I get it. If you just look at deal count, this looks like an industry in a hospice and ready to die, right? Down into the right. However, this was obviously in 2017, the comparison makes sense because it's where the industry was just a white paper and Telegram group, which makes it particularly concerning that we're back to those levels. So the thing that the chart doesn't show you that I wanted to talk about is that in Q1 2026, so right now, we're actually tracking to nearly $6 billion in total funding in the industry. And so what's happening is actually not a retreat in terms of investing in the ecosystem, is actually concentration. So there's fewer bets right now, much bigger conviction, and the average deal size has gone quite massively up. I think there's quite a few reasons for this, but for example, examples you have Rain raising $250 million for stablecoin payments. You also on the M&A have, BVNK that we're very familiar with being acquired by MasterCard for 1.8 billion. We've had a few IPOs. So there's a shift to growth stage infrastructure bets by serious institutional capital versus a lot of the pre-seeds and the seeds types of rounds that were actually happening before. So look, what's not getting funded? No one is writing a check right now for decentralized Jupiter anymore. That's pretty clear. Nobody's writing, a check for a layer one with a novel consensus mechanism that nobody asks for. And what we see as the capital is going to stablecoin rails, custody, insurance, regulation and compliance, tokenized real assets, the compliance tooling overall. What this reads to me as, it's not a dying industry, is an industry that is finally that finally grew up, not just growing up, but it finally grew up. This should be what we actually look at as a healthy industry in terms of composition of what the actual deal count is, and appropriately for the size of the pie, of course. So this has compounded the bad feeling by the tourist VCs essentially living crypto. Lately has been all the rage. And some of them were very loud voices on crypto VC. And just this week, they literally said crypto VC is dead and that crypto VC will never come back. And this is categorically different. This is ironic, of course, because they made all their money in crypto and they made their money by sticking around through the cycles for what it's worth. But it seems to me that what's actually happening is just there's more capital deploying to fewer fewer deals that are better companies that actually have revenue, regulatory moats, institutional customers, and this shying away from tokens. And so the final thing that I say is that, look, every single boom in crypto was preceded exactly by this kind of trough in deal activity. In 2018 and 2019, you guys remember it was a graveyard for deal count. And then DeFi summer happens, right? And then late 2022 felt like the end, and then the ETFs got approved and the market re-rated up. And I don't know if I believe that anything has shifted categorically, other than we now have many more types of crypto deals and fintech deals, and these new rails that are created are so exciting that this does not look exactly like the crypto deals that used to. And so the composition, I think, here matters than everything. So I think even if